in the first. Tesla delivered 336,700 vehicles in the first 3 months of 2025. That's a 13% year-on-year decline, and it's the lowest deliveries since 2022 and the sharpest year-on-year decline since the Model Y. We're going to talk about that and tariffs and hedging with Brian Stutland when he joins us today on Open Interest. Hello, everybody, and welcome. I don't know if you're still listening to some music. I'm still hearing it in my ears. But Tesla on Wednesday reported a double-digit drop in first quarter deliveries. That amid growing backlash to CEO Elon Musk's involvement with Doge and the Trump administration. The company delivered 336,700 vehicles in the first 3 months. That's a 13% decline from the same quarter last year, as I previously mentioned, and the sharpest year-on-year decline. Now, this is occurring at exactly the same moment that some competing auto companies, including General Motors and Hyundai, actually announced double-digit sales increases. Honda and Nissan also saw better than 5% sales growth. Of course, those strong performances might be related slightly to anticipation of the tariffs, and perhaps people thought there were going to be some price increases. We are actually monitoring this in real time, of course, because President Trump is currently speaking in the Rose Garden. You might even be able to see that on the monitor behind me. And he's making some announcements about tariffs. Also, we're going to be joined very shortly. Brian Stutland is going to be joining us. He is, of course, probably pretty busy with all of the day's activities. So he's going to have the opportunity to answer some questions. I see that PC, who had asked a question about SPX hedging strategies, is going to be joining us to answer that question for you, PC. In the meantime, I wanted to mention that in an article which some of you may have read if you subscribe either to theoptionsedge.com or if you subscribe to CNBC Pro, you may have seen this. In mid-March, I had discussed Tesla. The stock was lower than it is now, and I had proposed a couple ways to trade it at that time. And if we share my screen, I actually preloaded two of the trades I discussed. Both of these were to be initiated at zero premium. So both of them were short 2 options for every one that you were long. I think the stock was trading around 225-ish or so at the time that I made these recommendations, but I commented that I thought that the stock would probably find a floor. I recommended a no-cost 225, 195, 1x2 put spread. That thing is now at about 61 cents, so still effectively at zero cost. The stock clearly rallied thereafter. The other trade I recommended, again, looking ahead to this catalyst, was a call spread risk reversal. And this was the April 25th weekly, same expiration. 275, 310, 205 call spread risk reversal. Selling the 205 puts and buying the 275, 310 call spread. That also could have been put on for essentially no net premium or even a slight credit at one point. As of today's closing prices, that is just under $12. So $1,200 profit per spread if you happen to have put that on. That's something to think about, because now that the sales numbers are out, and they still have earnings coming up, and this does capture those, right? So they're going to be announcing on the 22nd. Is that correct? Let me double check that. And let's see what the implied. So big implied move. This is actually, bear in mind that because the sales numbers came out today, it's possible that there will be a little bit of a vol crush coming out of today's announcement, and there was more than one. But the sales numbers were one of the announcements. We obviously have earnings upcoming. And the final thing, and I think this is very important, and I don't know whether the news has hit officially, but it was reported by Politico that Donald Trump had told administration officials that Elon Musk would be leaving his post at Doge and basically in the administration very soon. So I don't know if that has officially been announced. It probably will be announced as a part of this tariff announcement or Rose Garden announcement, I'm guessing, considering the fact that it has already been released. But it would seem that the immense pressure that protesters have put on Tesla, and this may not be the only reason, but I'm going to guess that it's the primary one, that the firebombing and vandalism of Tesla stores and Tesla cars, and actually even of Teslas that are just privately owned, and also some basically concern from shareholders about these sales numbers are pressuring Elon to refocus his time and attention on the car company and not trying to cut waste, fraud, and abuse at the government. And that's, I think, one of the reasons we got this sort of late day rally in the stock. Now, it sort of came and went. Let me see if I can pull up we have a chart of it. I'll just pull this back up here. So we can see we got a little bit of a bump here. But of course, the stock is still down very sharply on those sales numbers. And I don't know what everybody else's feelings on the matter are. I kind of felt like this was an almost inevitable result, because ultimately he does bear a fiduciary responsibility to the shareholders, and it was clear that his involvement, whatever you happen to think of it, was beginning to impact the company and its shareholders and its employees too. I mean, there are people working in these stores, and they're contending with people at best chanting and waving signs around outside these stores, but at worst doing a lot of damage and arguably putting people at significant risk. So I guess we should have been reluctant to believe that he was going to be able to maintain that position for a really long time. So I think these trades, one can stay with them. Because Tesla is higher now, one of the things I would suggest with this call spread risk reversal is that you may want to contemplate raising the strikes a little bit, right? Because this is now in the money. So you could actually roll this position up. For one thing, I would certainly, at the very least, roll those 275s up, if not up and out, to a slightly out of the money call option, maybe the 285s. You could potentially even look to go something like a 285, 320, take it up like that. And you may also want to take up this short put at this point, particularly, I think, if the rumors are announced officially that he's going to be leaving the administration. I think that is going to alleviate some of the downside pressure on the company. I don't know if it will do all of it, but this is just a way to monetize some of the money that was in that call spread risk reversal, still maintain a position going into their earnings numbers. I don't know how meaningful those earnings numbers are going to be, though, now that we know just how profound the sales declines have been. Okay, so just to get back to this, because I remember that PC had asked these questions, and when Brian joins us, hopefully he'll be able to answer some of these things with his perspective as well. I know, PC, that this was a question you had asked previously. Okay, so I'm hearing that Brian has connected. There he is. I hear him. Hey, there he is.
How you doing?
How are you, sir?
Good.
Good to see you. I hope your travels went well. So the reason that Brian wasn't joining us for the last couple of weeks, he's been on the road for 2 weeks. Was that business or pleasure?
Mostly pleasure, actually. Yeah, a little spring break action here in Deerfield, the north suburbs of Chicago, off of school. So getting some sunshine, Arizona sun. And happy to be back here, though, talking markets just in time for for all this tariff news coming out now.
Yeah, this is pretty wild. I was right before you joined us. I'm just going to give you the highlight of the things I was discussing because one of the rumors, which I'm sure you probably saw, is that Elon Musk is going to be leaving the administration very soon. Um, and I assume that that is because of the considerable pressure that Tesla is under based on two things. Number one, the protests, and number two, the sales numbers that we got within the last 24 hours, down 13% year on year, which is pretty much the worst year on year decline in sales that we've seen for Tesla. So before we get to some SPX questions on hedging, which I think are right up your alley, and people were eager to get your opinion on them, I just wanted to get your thoughts on what's going on with Tesla. And also whether you think that it could potentially support the stock, that he's going to sort of return to the helm of his other businesses and not the biggest business in the world, the U.S. government.
Yeah, well, I think Tesla obviously up 5% today. That I think the market likes this news, and it's really probably the right move for him to do. It was maybe getting to be too much, trying to run a country, run Tesla, send rockets to Mars. Um, Sending rockets to Mars and building a car company in itself is a lot to handle, let alone trying to run basically the superpower of the world in the U.S. And be the right hand man to Trump. So I think this is the right move. He'll probably still be involved. I think in a lot of degrees of what's going on. It just is. I think he's going to try and take a back seat to all this and not be the forefront kind of guy, and then that'll allow him to focus. And you mentioned obviously the car sales numbers, not good. So he's got to focus on turning that around and getting things going. Tesla Autopilot. I was just in Arizona, speaking of vacation, and Waymo, such a huge presence there, driving cars around. I mean, Tesla's got a lot of catching up to do to catch up to where Waymo is at, and he's got to start to focus on
that. Yeah, I mean, as you know, as a Tesla owner who's undoubtedly used full self-driving, I have used it in my wife's car. I think their technology is very impressive. I don't know that it's quite as impressive, and whether or not they should incorporate LiDAR, for example, the way that Waymo does, which I think the folks at Waymo have pointed out that they didn't think that the incremental cost of those additional sensors was so great. The thing is that, of course, cars have a life cycle that is not typically that long, so it's certainly possible for Tesla to introduce that. But I agree with you, for it to deserve the multiple that it currently enjoys, and let alone get back to the one that it previously enjoyed, people are going to be buying this thing on the promise of things like robotaxis. The valuation doesn't make any sense as a car company alone, so you really need to see some traction there. So let me just quickly ask you a couple of questions on SPX and VIX that we were asked and specifically directed to you, and then I'm going to get to some things about vol crush and stuff like that. Okay, so question number one, could you walk me through your typical process for determining when and how to implement SPX hedges, including the key market indicators you monitor? And I'll give you this second part of the question as well. How do you quantify and manage the potential risks associated with your SPX hedging strategies? And what are your stop loss or profit taking criteria?
Yeah, I mean, it's a good question, but it's a complicated question. I think if I went in through every detail, it'd probably make your head spin, really. But I think just maybe more in simple terms when it comes to hedging. I think there's maybe really two key indicators people can watch. Number one, when I start seeing the market continue to make new highs, but the VIX make higher lows. In other words, let's say market makes a new high, VIX is at 12, and then next time the market's at a new high, VIX is at 13 or 14. To me, that's an indication that now there's some buying pressure going on in the S&P 500 options, and that's what's sort of propping VIX up, propping volatility a little bit higher and expectations for some sort of sell-off. So that's one way to look in terms of wanting to initiate a hedge on the downside, in terms of maybe think about buying a put or a put spread if you have a certain target where you want to stay protected. You don't need to just buy an outright put. You can You can buy a put, start to trade around it, sell another put to the downside as the market flushes downward. And then the opposite side, which is something I think is important to notice, when you take a look at what the markets did, March 10th was the low in the S&P 500, and yet, the market kind of trended around that area, and we saw VIX go from between March 10th and March 13th from 27.5, VIX went down to 21 and change, right? So now the opposite was happening. The market was sitting around new lows, and the VIX was making lower highs. That might be an indication to maybe take those hedges off at that point, or look to make a bullish play in the S&P 500, whether that's buying a call spread or selling a downside put if there's a level to get comfortable with. I think familiar trade that I think Mike, you and I like doing is where you buy a call spread and you finance that by selling a put on the downside. So when the market moves away from that long strike, that call strike, to your short strikes, you get to participate in the volatility dropping at those levels. So those are a couple strategies to look at. Those are maybe the very layman's terms of looking at it. We obviously have sophisticated models when we look to trade in and out of volatility and managing that with equities. I think it's just maybe a little bit too complicated going on a show here today, but those are a couple key indicators that I like watching.
Yeah, it's interesting because I received a similar question on Monday, and I made one of the points I made is that if vol is up, so for example, if the VIX is above 20, that's a good sign that two things have taken place. One, it's very rare to see the VIX at levels that carry a two handle or higher that wasn't precipitated by a market decline, which means that some of the damage has already been done, which would suggest that potentially using a put spread or something like that, rather than an outright, say a 1 month 30 delta put or whatever a technique or approach somebody is using, might make some sense, because if some of the damage has been done, then what's left is likely to be somewhat smaller. So if you're already in a correction, another 12% decline and you're in a bear market, but you're not going to get the same bang for your buck buying puts in that scenario. The other thing is that vol can come in if the market settles at a new level, and therefore your put protection is going to afford you less profits in that event, because you could be making money on delta, but you could be losing it on a combination of theta and vega if you sort of settle in a little bit. I think that's kind of what you're potentially referring to there.
And Mike, I just want to kind of interrupt here because I think it's interesting. The S&P fell about 150 points just now. They kind of announced, I'm just looking over here on Bloomberg Live blog, all the different countries and areas of the world with tariffs, and it does seem like a little bit more than maybe what people expected. S&P kind of coming off the lows, but the E-mini future touched 5,600, bounced back up to 5,630. So we'll see what happens, but huge drop in the market. So obviously people not really liking all the amount of tariffs coming out. It looks like European Union tariffed at 20%, Vietnam 46%, Cambodia 49%, Taiwan 32%, Japan 24%, South Africa 30%, India 26%, South Korea 25%, Thailand 36%, Switzerland 31%, Indonesia 32%. So a whole bunch of line of tariffs just coming out, hitting the tape right now.
What is interesting to me about the numbers you just cited is how specific they are.
Yeah, I know.
That you're talking about 32% for one country and 31% for another. These seem like so. I'm assuming that part of this is just like for like or tit for tat, maybe would be another way to describe it. I'm a little bit concerned, I will say, about, and I'm curious whether this ends up happening. So I've sent out some posts about this. I'd be curious to get your thoughts. One of the things that he mentioned in his speech before we went live, and something he's mentioned on numerous occasions in the past, was VAT taxes. So VAT taxes are value-added taxes. One way we don't have VAT taxes in the United States, but a way that for those unfamiliar might be able to think about it is it's a little bit like a sales tax. There's a sales tax that's imposed at various levels in the value-adding chain of production, and that it gets imposed on the cost. Now, how those VAT taxes are applied to goods sold in the respective countries where they apply, it can vary based on the products, meaning that whether it's a domestic product or a foreign product, whether it's an individual buyer or a business buyer, sometimes they get credit back for those VAT taxes paid and so on. But my concern was this suggestion that I kept hearing, and I wasn't sure how much nuance was being applied, that they were going to match the tariffs, which would be the import duties for a relevant country. So, for example, in the UK, a US car gets a 10% import duty, and then also take a look at the VAT taxes that apply there and tack that on as well. And I was hoping they would not do that because that gets a lot messier. What are your thoughts?
Yeah, I mean, it does. And I think, when you talk about these tariffs and the numbers, he's like revealing it. Like, I mean, people are saying it's like, what I'm seeing on like the chats, it's like, it looks like a game show. Oh, hey, next one is, 32% or whatever. And I mean, to your point with, VAT tax and reciprocal, I mean, it seems like they've done a very calculated version of, hey, these are all the tariffs and taxations that we're getting from these countries. So here's exactly the reciprocal tariff we're going to slap back at these people. I mean, oil's turned negative now, and the market's still kind of drifting back towards its lows. So this could be an interesting trading day tomorrow.
Yeah, I mean, you mentioned India. What was the number you came up with for India?
India looks like what did we go to here? 26%. 26% for India.
So that's lower than I know that number is lower than what they impose on a lot of our goods.
Yeah.
Although I also know that Modi had said that they were going to lower some of those tariffs sort of, even a priori. Before all of this, they were sort of in anticipation of a potential trade war. They had said, oh, we're going to reduce some of these. So I don't know whether they had articulated specifically what those reductions would be and when they would go into effect. But some of their tariffs were close to 100%. And so this number 26 is substantial, but it's certainly well below what reciprocal for the prior tariffs would be. Now, I'm curious I think one of the big concerns here is that these are bigger numbers than I had anticipated. I actually thought, I had thought this 25% number was the upper boundary and that they were actually going to come in lower. I thought we might be hearing like 10, 12. And I think the market traded like that today as well. And he also had made some comments from the White House that they were going to be nice. I don't know that I would describe this as nice.
No, I don't think it is. And I think you're right. That 25% number, I think, was something everybody had in mind, that maybe it would come in a little bit less than that. And it really, I think it's been a tit for tat total calculation on, hey, you guys, these are your total tariffs. Now we're going to, really, this is reciprocal tariffs. So this is going to be very interesting how this plays out. The S&P now trading 55.80. So at the lows of the session in after hours here, well, I guess considered still regular hours up until 4 o'clock Central. But yeah, this is probably on the higher end of what expectations were, like you mentioned, 25% being that high end range. So some countries getting hit harder. And I think people are worried about tariff on Taiwan and the semiconductor industry being somewhat significant too, as being a big factor in a play on the semis, which obviously a big portion of the S&P.
Yeah, I mean, we also got results coming out of Lulu. And, Lulu, what we heard from Lulu was basically that the forward sales guidance was not great. We'd actually put on a trade recommendation in Lulu, a 1x2 put spread, and it basically ran right to that short strike. But, this is pretty highly inflationary, the kinds of tariffs that are being proposed here, and disruptive, because you can imagine that right now there's a lot of C-suite gnashing of teeth, like, what are we going to do about this? A company like Lulu doesn't manufacture in the United States, and they're facing declining sales, and now they've got to think about their supply chain. I think they have 4 Asian countries where they're running plants, and so now they're going to have goods that could potentially even have different tariffs depending on which of those countries. That seems pretty messy to me.
Yeah, it certainly does. I think what will be interesting here is we're seeing VIX futures trading about 70 cents higher in the front month here. 2160 is the front month, so they're up a little bit. Not, but kind of like I talked about, where the VIX really at this point is not popping to higher levels. I would have expected a fall of 150 points in the S&P to see VIX futures spike tremendously. They're not. So I would say maybe that's the one bullish sign, is that maybe things will just kind of just settle in and the price is already kind of baked into to the area of the market here. But we'll see.
I mean, actually, that's a good question. No one has asked this, but I'll actually pose it to you. The way we used to think about the VIX movement, if somebody said to me, Mike, the S&P just fell by 1%, and this is 100 points is more than 1%, considerably more than 1%, I would have said, okay, all else equal, normal market conditions, S&P falls 1%, I'm going to guess that the VIX is up 90 basis points to about 120 basis points. That's my sort of threshold of VIX delta to SPX delta. But I would add that when you start breaking out of, say, a 1.5 standard deviation move for the S&P, that's when I would say that relationship no longer holds. In other words, if you get a 3% down move in the S&P, that does not mean that the VIX goes from 18 to 21. The same way that it might go from 15 to 16 if the S&P falls 80 basis points to 100. What are your thoughts?
Well, I kind of measure it maybe more like around on a percent to percent basis, where the VIX maybe goes up about 4% for a 1% down move in the market. I think that's kind of like been the historical ratio of the two. And obviously, as the market has sort of
that works out to about the same number, though, I think.
Yeah. So I would say, like you said, now you're looking at 1.5 standard deviation, 2 standard deviation move. You're talking about maybe a 2.5% fall, 3% fall in the market now, actually. Just looking over it here. Yeah. So I would have expected the VIX to be up around 30, to be honest, when something like this happens. But I mean, the market's already near the lows of where it was, like I said, on the lows of the March 10th. We're still just above that. So maybe the VIX doesn't get there, but under normal circumstances, that's what I would expect to see. And maybe weekly or daily options have somewhat of a play, because you can kind of get the day-to-day temporary blips of that 3% move wrapped up into daily or weekly option implied volatility, and people rather take that vol up versus back month volatility. But I don't know, I would still expect some volatility to remain in this marketplace given the amount of sell-off we're seeing right now.
Yeah. So a trade that I happen to really like in a variety of circumstances, a lot of times I have, and I did a lot of these in the first quarter of 2024 going into earnings. I did a lot of strangle swaps going into earnings, where I was long dated vol and then short nearer dated strangles going into earnings in certain stocks. The first question I'm going to ask you is, what are your thoughts about that strategy? Do you ever use it, or how do you think about calendars going into catalysts? And if you do, how do you typically employ them? And then we're going to get a question here on vol crush. So I'll let you fire away on that one first.
Well, when it comes to calendar or straddle swaps, like basically trading like at the money time spreads, I really kind of just use that as a way to hedge off and lay off risk as a market maker. As a customer trying to initiate positions, I think it becomes a little bit more cumbersome to manage to some degree. There are maybe some opportunities where you feel like, hey, near-term volatility is too low. I want to buy some gamma, and in the long term, maybe things start to settle in. So I'll sell some back month gamma against that. That's maybe one way to play like a long gamma trade into short gamma after the event, has happened. But typically what I'll just do is maybe just trade the front month to be easier as a customer. I might just trade just the front month, maybe on a smaller level, smaller notional value, and just manage the front month gamma the best I can, is what I found is the best way to do that.
So, actually, when I was employing them, I was actually going the other way. So I was actually typically buying 4 to 6 month strangles on the underlying,
Mm-hmm.
and selling anywhere from, call it 14, 15-day strangles out to, call it 45-day strangles, going into earnings in those circumstances where I felt like long-dated vol was in a reasonable place, but the implied move seemed a little extreme, particularly if and as the circumstances gave me a setup where I thought I might be comfortable getting, say, long the underlying at at price near here.
Yeah.
Because then what's the downside? I get a sign on my short put. I own some long dated vol. It played into another piece of logic as well, which was that if I felt like long dated volatility was reasonably priced, and you got some kind of a real shakeup coming out of earnings, you are facing risk because you're short that downside put, but oftentimes you enter a new volatility regime. Folks that are looking at a stock are saying, hey, wait a minute, everything we thought we knew isn't quite right. And so all of a sudden you get, sort of an uptick. A perfect example of that would be Disney, 2015. So late summer earnings release. I don't know if you remember this, but Disney was like this money printing press that owned ESPN, which accounted for 40% of their net income, and they just consistently churned out money. And then in 2015, they had a quarterly earnings release, and actually I was, had advocated, buying some downside, always traded at a premium to the market, and then it came out with a disappointment. And Disney has never really fully recovered its mojo since then. But if you owned long-dated vol in Disney going into that number, that probably paid off just fine. So the question I think that AMTB here is asking, so these only worked when the front and back were close in dates. When far apart, the P&L became a loser after earnings. Can you clarify your method? So this is interesting because that is not typically what I do, number one, and that has not been my experience. So it definitely, an important point I think people, and this is what I think Brian was talking about, it's case by case. You really have to evaluate what you think about the underlying stock, right?
Yeah, I think, just circling back on your method of selling maybe a downside put and buying a back month put, that's definitely an interesting play when it comes to just trying to pick some levels where you're trying to get kind of willing to get long the stock. So it's interesting because when you first put it on, it has a short negative delta. Well, if you don't do it as a strangle, let's just break each part. The downside put technically has a short delta because you're long the longer dated put, which has a higher delta. You're short the put, the front month put, or near-term dated option, which has a lower delta. But if we go down through that strike, you're getting technically synthetically long a call because you get put to the stock and then you have the protective put. Which, when you flip it around, turns you into a call. So that a call, as we know, has a long delta. So your delta goes from a short delta to a long delta, which is the short gamma effect of near-term options. And so this is why you need to pick strikes where you're saying, look, there's going to be some support down at this level such that I'm okay being long some deltas down there. And then what ends up happening is it ends up really kind of being a nice hedge to whether you own an upside call or you own the other part of this strangle swap, or you own stock against that, and you're willing to sort of price average down at some lower level. That maybe sometimes makes a good play. And, like you said, sometimes those implied volatilities get stretched so far apart from each other that the value of that time spread becomes attractive. That's when I would be really looking to put this on, is when that implied volatility levels get stretched so far from one another between the back month and the front month. Then it's like, okay, listen, the back month, you either got to come up, the front month, we're not going to get there. So one of the two has to happen. And then, you're in a good position to sort of take advantage of that.
Yeah, I guess I would also elaborate for the viewers here that the reason I referenced the first quarter of 2024 is that folks who have been watching probably have noticed I've done somewhat fewer of these types of trades more recently because I've been doing a lot of call spread riskies. I've been doing 1x2s in some instances. And largely the reason I've been focusing on that is because I've had less conviction about the level of longer term volatility in a lot of these names. And if I was just simply making a directional bet, I was making a bet that I think near-term volatility might be a little bit high, or that at least it was setting up such that you could get a favorable risk-reward characteristic relative to the price of the underlying. But I will make this point, and that is that when I bought longer-dated premium, I was looking to acquire it at implied volatility levels that I thought were attractive in a historical context for that tenor. That's the first point. And the second point is I was always looking far enough out in time that I would capture subsequent catalysts, like the next earnings at the least. The idea being that the vol crush, in my experience, is most painful inside of 3 months when an event comes and goes. So if you own like a 30-day strangle, a lot of things have to happen in the earnings for that to be a winner, because the vol crush on that 30-day implied volatility is going to be significant post-earnings. What are your thoughts on that? Because I think this viewer has pointed out a number of calendars, but the calendars were weeks apart, whereas mine would typically be a minimum of 4 months apart.
Yeah.
What are your thoughts?
Yeah, I mean, I like that spread where you're more like 3 or 4 months apart from each spread to take advantage of the fact that near-term dated options are going to, collapse more quickly than the, further dated ones. And it also takes advantage of the fact that one implied volatility is so much higher than the other that, to some degree, the option prices are a little mismatched. And you will get that from time. It's kind of one that you got to study a little bit, though. I think, like, if you're watching these two stocks, I think you need to be somewhat familiar with where implied volatility levels are typically trading, not just like walk in and say, oh, great, hey, NVIDIA, this must be mispriced or whatever, just because the front month is 60 vol and the back month is 50. I would want to be watching where those things kind of trade historically, and if they get separated from each other, there's some opportunity to take advantage.
Yeah. Actually, I'm going to pull up an example. I'm going to throw Tesla up on the screens here. So I just really want to elaborate on this because AAMTB's issues with this, I just want to make a point. We were trading these strangle swaps, and again, in the first quarter of 24 is when I thought things were setting up pretty favorably. We were up, I'm going to say it was in the neighborhood of 15% over the course of 2 months on the capital base. And we were typically running 10 to 20 of these things at any given time. And, we weren't trading, we were not trading every single earnings. We were, I'll give you a couple of the thresholds that we were using, and then you can sort of, take it as you will. So first things first. Long-dated strangles would generally be at least 100 days out, but, going into earnings. We would typically initiate these trades with about 2 weeks before earnings and look to take them off within a week or so. So these were about 3-week trades. So just a couple things to think about here. We typically look for situations. If you're looking at my screen right now, you're going to see I'm using this as an example. These are the historical moves for Tesla over the last 11 quarters, and then including this upcoming quarter, which they're going to be reporting in late April, the expected move on earnings here. So generally speaking, we were looking for circumstances where we were selling moves that were, outside of what would normally be expected. This would be a perfect example of that. So I'm curious, AMTB, if you're still watching this, and you can just elaborate, because I'm trying to figure out what you were thinking of as terms of what you were buying and what you were selling, because your experience does not seem to align with what our trading P&L was, and maybe there was something else. One final point. Yeah, I forgot to mention this. We do these trades on liquid names. So we're looking at large cap stocks. Now, granted, there's a little bit of an institutional thing in here, which is that if you're trading institutional money, you can't trade things that trade 100 contracts a day, right? So we were typically in the top 250 constituent stocks of the S&P by market cap, and more often than that, probably the top 100. It just gets very you start dealing with small cap companies, and anything can happen, and the spreads can widen out. Typically you want to have something that has a lot of traffic in it, because you just don't want to be caught where something that was $2 at 210 one day is $1.50, $2.50 the next day. That just makes it very hard to live with. How about you, Brian? I mean, you have a lot of you have a lot of customers that probably aren't only trading the big stocks, or are they principally in those?
Yeah, I mean, for us, we kind of stick actually to the S&P index in terms of options. That's really our specialty. VIX options, S&P options, individual names. We'll make bets into earnings play, but like you said, we'll stick with the big names. Markets are tighter; they're easier to sort of trade in and out when you want to get out, versus some of the smaller names. I mean, you really have to have. I would say for smaller names, you really have to have a kind of a binary bet put on. Like, I'm going to buy this option and take a shot, like a lottery ticket, or sell this put because I just want to get long this one name down here at this level, because you're probably going to get one chance to trade it, and by the time you try and trade out of it, there's just too much edge given up to sort of get back in and out of things.
You just brought up something I'm so glad that you did, because it's something I've completely neglected to mention. Okay, so AMT said tried buying months out and selling right after earnings. So, my kind of sweet spot on a trade like this would be 100 to 120 days long and 30 to 45 days short. The reason I'm looking for 30 to 45 days short is because if you're looking to play a vol crush, there has to be some vol in the options. If I sell a Strangle that expires the day that they report, or the day after, because very few companies actually report on an expiration Friday. Usually it's the middle of the week, so Thursday is sort of a late in the week report. You're kind of a coin toss there, right? It's all gamma. But I have on my screen. I want to get Brian's thoughts on this. So what I'm showing right here is the 1 month implied correlation for the SIBO. So for those who don't know what this represents, and actually I'm not sure how Bloomberg's doing the calculation, but implied correlation is the relationship between implied volatility on the constituent stocks of the index and the price of options on that index. And as a back of the napkin way to think about it, the higher index implied volatility is relative to the weighted implied volatilities of the constituents, the higher the implied correlation is. And a simple way to think about this is that if stocks all behaved exactly like one another, then the index is going to be more volatile than if they don't behave anything like one another. So if stocks are just going in every which way, even if they are very, very volatile, the index might not be so volatile. And contrarily, if every stock moved lockstep with one another, so they had perfect correlation, then even if their respective volatilities was low for those stocks, say 22%, 22% is not an outrageous volatility for a single stock. But if every stock in an index is perfectly correlated and they all have that means the index is 22 vol, and that is high vol for an index, because indices benefit from the diversifying effects of the constituents they contain. And I want to show this chart because I'm wondering whether part of AAMTV's problem. Look at where implied correlation was when we were really doing a lot of these in the beginning of 2024. Implied correlation was very, very low. And in fact, I was hedging with SPX Strangles. In fact, people who are watching this show will know, because I was talking about it a lot, that I had them on. So I was long SPX Strangles, and then I was long calendar Strangle spreads in individual stocks going into earnings. The logic being that effectively I was getting long correlation. This is not a good way to do this, by the way, folks. It's much easier to trade long dispersion than long correlation. It's a very messy business. But as a rule of thumb, what are your thoughts there? So you can see that the regime where we are right now is so different than when I was piling these things on. So if you were following, if you just look at that chart, look at where implied correlation was versus where it is. if implied correlation is really high, then that could either tell you that the implied vol of the stocks inside is too low, or that it's high in index land and so on. So this may speak to one of the reasons why AMTB's experiences recently are not as good. What are your thoughts, Brian?
Yeah, I mean, I'm maybe not the best person on correlation trades, only because and dispersion models, because I kind of was fighting that as a market maker on the trading floor. I would kind of, pick and stick to my one area, my one niche against versus trading one thing against the other. Um, so I don't have as much experience maybe to speak to how that's played out in the different correlation regimes. Um, I look at it as more of a correlation of how much risk is in the market, and implied correlations as they go, higher or one-to-one with each other. Uh, then I look for maybe the VIX to trade at higher levels and more volatility to come in the marketplace. Because, like you said, when correlation is lower, each parts of the index are pulling against each other and bringing the index correlation or index volatility lower. So that's more how I look at it versus like finding a way to sort of put on a trade on individual names.
Yeah, so I'm getting a follow-up comment here. The ones that work better were back at earnings front right before earnings. That's an interesting point. So one, just as a little bit of background, dispersion trading is where I cut my teeth, right? So when Gateway and Bluefin, that's what we did. From 1997, 98, 99, 2000 through 2001, dispersion was our whole game. We were typically long dispersion, short correlation, just as a function. So for those of you who are trying to understand what that means, we were long constituent stock vol and short index. And during that period, it was the NASDAQ index specifically. So we were in a lot of tech stocks. We were long volatility going into the tech wreck and coming out of it, and short NDX volatility against that. Part of the reason is that at the time, those relationships were not as well understood, I think, as they are today. The second is that the ETFs had just been released, like triple Qs and SPY and things like that. And the demand to own options on those things was very great. So even if people understood where they should trade, that didn't mean that's where they did trade. And so we were able to, and we also got very nice cross margining in our JBO with Goldman. They didn't, they would scream sometimes at the size of our positions, but generally they kind of let us do it. So that was another big part of it. So one of the things that I think AMTB is asking here, and that is that selling vol ahead of a catalyst in options that expire before that catalyst. My observation, somebody did this study, and you will know better than I. But the study showed that sometimes the best volatility risk premium capture strategies happened in low volatility environments. In other words, the vol would decline, implied vol, and realized vol might go, to low single digits.
Yeah.
But you would actually get a better capture in those cases than you sometimes did in higher vol environments. Is that true? And this is, you're an SPX guru.
Well, I think what happens sometimes though is that you get to like these super low realized in volatility environments, and the price of premium of options are so small that people are a little bit wary to sell those when you're looking at like a percent of return on your money, or the percent of premium that the option is relative to the underlying stock price, right? And there becomes a little bit of a binary effect too for premium buyers to say, look, it's only going to cost me a quarter. I'm going to take a shot that this option finishes in the money. And yes, I do find lots of circumstances where those premiums are very elevated, implied volatilities are very elevated relative to where realized volatility is at. Now, that merry-go-round, when that stops and it reverses is the danger part. And for that reason, I prefer maybe like what a put spread, let's say, if I'm going to try and capture, to have some sort of defined risk where if it blows through my short strike, I'm at least re-stopped out, with a long put that's further out of the money. So I might do more like a condor kind of strategy to sort of echo that sentiment when that happens. Condor being you sell a put spread and you also sell a call spread on the other side of it, that's another way sort of to capture the short dated premium of options, especially in very low volatility environments. But, that's not necessarily an environment we're in today.
Yeah, actually, that brings up another interesting question. I mean, how are you positioning right now? I'm going to pull up also on my screen here. So the implied, I'm going to just show the volatility for Tesla because it doesn't really matter whether they're looking at Tesla or something else. But if you are trying to trade the calendar, whatever you're trying to trade the calendar in, Brian, what are the top 2 or 3 things that you think folks ought to be looking at? So assuming they have access to information like what I'm currently showing on the screen. So you can see realized vol. You can see implied volatility with a historical context. This is a time series. Maybe you have an IV rank. Maybe you have an IV percentile. What do you think people should be looking at to decide whether they think volatility looks like a reasonable purchase or sale?
Well, what I'd be looking at, like for today, basically, is we are in this higher volatility environment, which actually means that the market actually kind of typically realizes those higher implied moves. And so when you're in this kind of environment, let's say you are long this backdated strangled, so to speak, I rather maybe look to sell strangles as the market moves. So in other words, I'm long this strangle, market goes down. Now I'm getting some short deltas. Then I sell a near dated put, and vice versa. Let the market come back. And hopefully after a big move has been made in the market, that you sort of get this like sort of range bound but volatility movement back and forth where you continually scalp, and play the gamma moves and readjust positions and strikes or sell other options around it. But I do think you get more times than not where the market actually realizes what these high implied volatilities are indicating today.
So if I can paraphrase, you can tell me whether I'm interpreting what you're saying correctly, that you're kind of taking a technical, maybe, and combining that with a fundamental approach. I'm willing to get long the underlying at this level. I'm willing to sell the underlying at that level. And maybe the market volatility starts to come in so I can profit off of a little bit of a vol crush and decay. Worst case, I'm going to get long and short at levels that I had previously defined as acceptable entry and exit points.
Yeah, well, I think, and also too, I want to have bullets available, right? Like if I were to just in a higher volatility environment buy the back month strangle, let's say, hoping that volatility is going to come down and I'm going to sell, let's say, 30-day strangle, I'd rather leg into the 30-day strangle because and wait for the market to move. Implied volatilities are higher because the market's moving. You're going to get enough movement back and forth where you can trade sort of the gamma of the back month strangle and allow yourself to pick, let's say, even if I have a level I'm willing to get long or short, I might have that level, but I want to see it move closer towards that level where now I've gotten a little bit more premium out of that near-term dated option only because the market's moved closer towards that strike. But then that becomes a better opportunity to collect that income and still, believe and achieve in those levels, I like to say.
So do you kind of think of it like, oh, I own some gamma in the long-dated premium, and then I'm going to hedge my deltas by selling short-dated premium?
Correct. Yeah.
It's interesting that you should mention this because I don't know if you know Bruno Dupire. He's the chief quant at Bloomberg, or do you know him? He's a Frenchman.
I do not, but
people who are interested, you spell the last name Dupire. He's an interesting guy. He used to give this presentation all the time where he talked about time arbitrage. And what he was pointing out was that the volatility is not continuous the way you would expect. In other words, if you divide by the square root of time, it doesn't work out exactly right. So if you have an annualized volatility number, that the intraday volatility was often very much higher than that, but the week-to-week volatility was not. So what he actually suggested, he said, well, what you want to do then is trade as if you're long gamma day to day, and trade as if you're short gamma week to week.
Okay.
And what the interesting thing is, he said, you don't have to have any options to do this. You just pretend. You basically pretend that you're long gamma intraday and trade accordingly, and then true up your deltas weekly or monthly or something like that, and that you would ultimately end up being profitable. And what you're suggesting is kind of a similar approach to this, which is that you're not technically long gamma if you're short near dated options or if you're selling them. But you're saying you sell them as if you're just trading against the long gamma that you possess and maybe using some fundamental and technical indicators as well. That's really, that's interesting and helpful. And it's borne out by his work.
Yeah. No, I think it is an effective level, especially in this market environment that we're talking about today. If like I need something to trade tomorrow, when you look at the levels, like I mentioned, 55.50 in the S&P has really been a level you bounced off of on the low side. 50.
Where are the futures right now?
Well, we just closed 10 minutes, but they were trading. They closed at 55.85, which was down significantly because they got as high above. They got up to 57, looks like 75. So 200, almost a 200-point drop from where they were trading before you started speaking to where they were after. Now, the one thing actually I did notice that there were no reciprocal tariffs on Canada and Mexico.
Yeah, I think the producers just actually had that up on the screen. Maybe you can bring that up again, that lower third that you just had there. So it says, the Trump administration announced Wednesday that Canada and Mexico will be exempt from the baseline 10% tariff rate as well as reciprocal levies for specific countries for now. The 10% tariff would only kick in when the original 25% duties Trump slapped on Canada and Mexican imports are terminated or suspended. The 25% tariff was based on allegations that neighboring countries were failing to stem the flow of drugs and crime into the U.S. So it seems like with respect to the tariffs, and it looks like we've got them up on the screen here. So the 10% number, this baseline tariff, that's what I thought. I'll admit that's actually the number I thought we were going to get. I thought we were going to hear 10% tariffs, and we will look to potentially raise those if guys don't come into line or meet our numbers. So the numbers that you cited really caught me off guard. To be honest.
I guess Trump had commented that that they were nice though because they were only maybe half the value of tariffs that are placed on the United States from those particular countries. So somehow they must have come up with a calculation of saying, let's sum it all up. What does this amount to from, let's say, Taiwan, and their number is X, and we're going to put a reciprocal tariff of Y that's half the amount of X back on these places. Yeah, like right there, it lines up to be about half at each place. So
that's what Eileen, one of the viewers, just sent us a message and said, wow, they just literally took whatever they charge us and divided by 2.
Right.
Although what's going to be...
It's interesting, though, that those numbers of what they charge us. I mean, it's kind of eye-popping how much tariffs are put on us.
Yeah. So I agree with you. It is... So there's a couple eye-opening things about this. Number one, well, let's think about this. Let's just do a little bit of back-of-the-napkin work here. We import just north of $4 trillion worth of goods from overseas each year. Right? So 4.1 trillion was the number I saw most recently. This is... So to impose, let's just say you take a 25% tariff on a $4 trillion import figure is $1 trillion in tariffs. That's a big number. That's 3% of GDP. It's pretty eye-watering. It's more than 3% of GDP, actually. It is possible that these other countries come into line. I mean, when you see these tariffs, this was not something I paid a whole lot of attention to, even as a professional investor, what other countries were charging us. It didn't really work in most of the models. It was not something we looked at. Was it ever something you looked at before? And what do you think of the numbers that you're seeing from overseas now that you've seen them?
Yeah, I mean, like I said, I didn't realize how much other countries, not just obviously not just tariffs, but other penalties and whatever put on us. That was so significantly high. Those numbers seem abnormally too high. I don't know if that like it's hard to believe that those are real, to be honest. And so if they
Well,
are
let me
real, then
offer
it
you
makes sense
this.
that we maybe it was time that we do half the amount at least.
We have a $1 trillion trade imbalance.
Yeah,
Something had to motivate that,
yeah,
right?
right.
And it seems clear that very asymmetric tariffs could have contributed meaningfully to this large trade imbalance
Yeah,
that we've had. And we need that to come in because I think this is an important thing for everybody to understand as we try to digest the fiscal realities of the United States. When we run a trade imbalance with China, that has to get paid for somehow. And there's really only two ways that that's going to happen. Either we sell assets to offset that trade imbalance, or we borrow the money. Right?
yeah,
There's no magic thing. It's not like China's going to say, you only sold us 100 billion and we just sold you 250 billion. So, you just keep that extra 150 billion dollars worth of goods and we'll true it up later. They get
yeah,
they're getting their money.
yeah,
They're getting it somehow.
yeah,
And there is a statistic. I encourage people to go find this. Warren Buffett signaled that this was a huge issue. This massive trade imbalance was an issue that the United States had to face. And I want to say it goes back to 1997 or something like that, but it's some time ago. But what he talked about was the net investment. Net investment represents how much of China's assets do Americans own and how much of American assets does China own. And essentially what he was pointing out was that as long as big trade imbalances persisted, the net ownership of U.S. assets by foreigners abroad was increasing as our ownership of foreign assets by Americans was decreasing or remaining static. So that essentially, at some point they could say, we own you.
yeah. Well, I mean, it's partially true, right? That trade imbalance is unsustainable over a long period of time. At some point, something has to give. We either print more money to make up the difference, which devalues our own currency. We take on bigger and bigger debts to pay for that trade imbalance, like you said, because, they're going to get their money. And certainly these imbalanced tariffs have probably contributed to that. I mean, there has to be a reason, an economic motivation for that flow to occur. So maybe that stops that flow. The question is, how does that affect our economy? And is that good or bad for the U.S. economy and GDP growth?
So let me pose a scary idea. Okay, let me posit that one of the reasons we've had U.S. exceptionalism in terms of equity valuations is the fact that we've had better GDP growth, but GDP growth has been sponsored in part by excess government spending, right? So if we've been growing GDP at 3% and rest of the world has been growing at 1%, part of the reason for that is that we're running a 7% of GDP federal budget deficit. Okay, so that's the first part of my question to you. The second part is that we're trading at about 24 times trailing and 20 times forward earnings, whereas Europe, for example, is maybe trading 16. Now, and also, let's just say rest of world. The rest of world's trading at 17 times forward, we're trading at 20. Now, if our superior GDP growth relative to developed countries is partially due to a fiscal deficit that's not sustainable, number one, and if the reason we trade at a premium is because of this net investment effect, that is to say that for when we run all of these big trade deficits, that results in net investment in U.S. assets, including publicly traded equities. And now we're trying to do something to reverse these impacts. Doesn't that seem to you that maybe that, number one, takes us into recessionary pressure because government spending goes down so much? And secondly, what about investment flows? Is this going to reverse the investment flows that's begun coming into U.S. equities and cause it to go back out to rest of world? Thoughts?
Yeah, I mean, look, the investment world that comes into this country certainly helps prop up equity values. It probably helps put that premium, like you talked about, that premium multiple of, let's say, the U.S. S&P 500 multiple 12-month forward PE versus European Union, some indices over there forward PE, and so that flow could stop. That is definitely a concern. I think what's more concerning to me, though, is the inflationary pressures that may occur to some of the pricing here based on this. And then you have that along with unemployment maybe starting to just not improve any better because we're already at pretty close to full employment. So, in terms of new manufacturing jobs that want to be driven from this change in tariff for U.S. to become this manufacturing hub, that manufacturing is going to be needed to be done by robots because there's not enough people, I think, to go around to bring in the lag. And so now if you have production problems, there's a whole bunch of things that can get out of whack. So that's the main concern I think the market is having for all this.
I guess what I'm worried about is that I saw this news came out this week that the number of open job postings has basically fallen back to pre-pandemic levels. So the available jobs, so even if we're at relatively full employment, that the number of available jobs seeking to be filled, if that's declining, it has to signal that the labor market is weakening. In other words, all of these things don't happen at once, but you look for cracks in the ice. And the number of open positions going down relative to the labor force has to be one of those cracks, wouldn't you think?
Yeah, that's always been sort of like the crack in the market. As soon as you see this uptick in unemployment and the labor market sort of weakening, that typically has led to more systemic problems in the overall economy and has led to heightened volatility. It's typically led to market declines. So that's something to really be watching over the next few months and how this plays out. Are we going to get inflation from these tariffs? And if so, are we going to also get higher unemployment rates? And so that would be a match, whatever you want to call it, of not good for the markets. So that's something to sort of watch and see how that plays out.
Yeah, I guess one way I would think about this in terms of inflation is that let's just assume, realize the tariffs are way, there's higher ones and lower ones. Let's just assume it's a 25% number. 25% number on $4 trillion worth of imports, that's $1 trillion worth of price increases, all else equal, and it won't be equal because imports will fall, which means that consumption is falling. But that's $1 trillion is over 3% of GDP. That's a big increase in costs overall in the economy. That's really, really big. I don't know how you don't. I mean, how is that not inflationary? If you're trying to get to 2%, how can you impose tariffs that are 3.3% of all goods sold in the country and not get something akin to inflation?
The only way it doesn't become inflationary is if the U.S. dollar strengthens and the other currencies weaken to offset the fact, and then other countries take the brunt of getting crunched on the profit margin that they're currently achieving right now from this. So that would be one swing to sort of be deflationary. I would like to see the U.S. dollar actually strengthen, but I don't think that this administration wants to actually see that. So,
they're trying to deflate the value of their debt. They want a weaker dollar.
Yeah.
They combined with lower rates. I'll tell you, this is a really difficult one. I mean, they're trying to get a whole bunch of things. What do they want? They want the fiscal deficit down so that to 3% of GDP. That's 1.4 to 1.6 trillion net of anticipated interest rate expense hikes, which is huge. They want these equivalent tariffs, but that's going to increase prices on $4 trillion worth of imported goods by $1 trillion, which is huge. So we've got huge plus huge so far, and I don't know. I mean, it's a very difficult path that they're trying to navigate here, and I have a hard time believing that. Again, maybe it's just a negotiating tactic. Trump has proven that he is willing to be nimble and change his perspective, but this one's a tough one. I don't know that 100-point or 200-point decline in the S&P is enough when I start thinking about it like this. Do you?
I know, right?
Oh, jeez.
I know. The more I'm brainstorming this and talking through this with you too, as I'm definitely worried a little bit about the downside. The one thing that may be baked into all this is support for the market is that, at the end of just reading here that at the end of Trump's press conference, he talked about now it's time to get on to talk about taxes. And, if this can sort of, one thought is at the beginning of your term, you put in all the bad news right at the start. You try and take the markets down. You panic.
Just like new management does.
Yeah.
Right? They kitchen sink it.
Yeah, right.
So you think he's kitchen sinking it?
Yeah, I actually kind of do. Bake in all the bad news now, slap this stuff on, which may make the market go lower than it is currently. And in the back half of the year, work on tax cuts and compromising on some of these tariffs and, kind of flush everything out.
Yeah, I mean, I actually, before this happened, I had been thinking, okay, how am I going to try to buy this market tomorrow?
Yeah.
That's what I was thinking.
Yeah.
Like, how do I play this?
Yeah.
I don't feel like that right now.
Honestly, I was exactly the same way. I was thinking, we hold here above 5,700 on the S&P. To me, that was kind of a technical indicator that maybe we go higher. And maybe looking how to position that. Now, I don't know. I've got to watch this downside here. I think, like I said, 55.50 on the S&P was the low back near March 10th. I'd be watching that level. I think if we break below that low, it might increase selling pressure from there.
Here's another way I would say it, which is that when I look at this tariff proposal, and I think back to the fourth quarter of 2018, the taper tantrum, you may remember, when the Fed started pushing stuff off the balance sheet. And I think about how the market behaved in 2022, which was that rate hiking cycle. This feels, to me, of approximately equivalent economic impact. In both of those instances, the S&P fell 20% from its prior highs or more. And we're not there yet. Right? So We're not anywhere near a formal bear market. Who knows? I mean, to your point, maybe the VIX didn't spike enough. Maybe you buy vol tomorrow. This could be, this could set us up for a fourth quarter 2018 kind of volatility environment.
Yeah.
Potentially.
Yeah.
With is your phone ringing off the hook from your clients yet? Are they saying, "What are we doing?" I want my money back.
Yeah, right. They might be after we get off this.
I hope Joe Pesci's not one of your clients, like in the movie Casino.
Yeah.
When he gives the money to the banker and he meets at Sam Rothstein's house.
Yeah.
Oh, I think I want my money back.
Yeah. Yeah.
Wow.
No, I mean, we'll be prudent. I do think we will probably get some triggers on a long volatility position potentially tomorrow if things move how I think they might. So hopefully that'll help us stay protected. And like I said, kind of have some stops on this market in place that we'll be watching throughout this week.
Yeah. All right. So for folks first of all, this has been a great conversation. I really enjoyed it. It's obviously fairly loose. We've been talking for now an hour and 15 minutes. For those of you who are watching it live and for those who are watching it recorded, like, subscribe, notification bell. What's your X handle? Because I think people may want to sort of keep track of your thoughts in more real time. This is a market that deserves kind of I think real-time monitoring.
Yeah,
That would be my take. We're in a schizophrenic situation here.
yeah, sure. Yeah, make sure you check in at Brian Stutland. That's my X handle. Go to equityarmorinvestments.com. You can get trade alert updates from us. We actually now offer a subscription that people can pay a monthly subscription to get those alerts. So make sure you follow along with what we're doing. Yeah, I'll be certain to update the market through that X handle and keep people posted because this will be probably a very volatile week.
Yeah, it's looking like it's shaping up that way. You going to be able to join us next week, maybe?
I certainly hope so. So far so good.
All right. Well, I look forward to that. So all of you guys, be sure to tune in this time next week, 4:15 Eastern Time on Wednesday, to get more of Brian's insights, and I'm really looking forward to that. And there's probably going to be plenty to talk about because this is going to be an interesting week. Hang on to your hats. Thanks for watching.